Hi guys, welcome back to my channel. So today I will be talking about a bit different from the usual growth stocks. Today I'll be talking about dividend stocks, because for investment it's always important to have a dividend portfolio and a growth portfolio, so that the dividend portfolio is a more stable and risk hedge, whereas compared to the growth stocks, which will give high returns but is definitely a more risky path. So a bit about my background. I actually live in Singapore. So in Singapore, we are actually quite fortunate that our dividends that is announced by companies are actually the actual amount, whereas for US companies, when they announce the dividends, they are actually taxed before they are being paid to you. So that's the advantage of investing in Singapore stocks. So in Singapore, there's a few companies that is well known to be able to hold for the long term for sustainable returns till retirement, and I'll be sharing with them to you. So today I'll be sharing with you this company called Mapletree Industrial Trust, which is one of my most favorite REITs out of the rest, and I will show you the reason why. So a bit about their background. They currently own 141 properties across 6 different property segments. So one of the most attractive part of this REIT is because of their adoption into data centers. As you can see, for the data centers, they have 54.3%. Following that, light industrial buildings of 0.6%, ramp-up buildings of 5.6%, flatted factories of 16.7%, business parks buildings of 6.5%, and high-tech buildings of 16.3%. So as I said, the best attractive part of this REIT is because of their data centers. Okay, so for REITs, whenever I look at their investor presentation, the first thing I'll look at to focus on is always their distributable income and their DPU, whether they are increasing quarter over quarter or year over year. And moreover, another important aspect to look at is their overall portfolio occupancy rate, which you can see is increasing quarter on quarter from 94% to 95.3%, which is a good thing because this means that they are earning more and thus they have more distributable income to distribute to shareholders. So another important aspect of a REIT is about their debts, because for REITs, they do not keep most of the values, so they actually distribute 90% to 100% of their income. So the way they raise fund is through shares or through debts. So when they run through debts, it's important to know how much they are hedged based on the total debt that they have. So hedging of the debt means that they fix the interest rate so that any volatile interest rate would not affect their earnings. As you can see now, currently in this environment, our interest rate is very volatile. So it's important that REITs do hedge to a certain limit so that they could be able to ensure that shareholders get a fixed amount of income that they can get. However, it's also important that they do not hedge too much so that they have some headspace to play around with. As you can see, for this MIT portfolio of debt, they actually had a 72.3% fixed, which is good. And as you can see, the cost, the all-in founding cost for the quarter, which is the average interest that they are paying on their debt, is 2.5%. Their interest coverage ratio for the quarter is 6%. So this ICR is actually referring to how much is the interest rate as compared to the income that they're earning. So currently, this means that the income that they're earning is 6 times more than the interest rate required to be paid for the debt, which is a very good parameter. So it's important that ICRs for REITs are at least more than 2.5 times. The amount of diversified tenants is also very important to ensure that in the event if one large tenant falls or leaves, it doesn't disrupt the whole income. As you can see from the large and diversified tenant base, MIT actually has HP at the highest of only 6.1% of the gross rental income. So this is a very good thing, so that no one company controls or determines the amount of income that the REITs earn. It's also important to look at their rental reversion rates throughout the different buildings. As you can see, the blue chart, which is the after renewal, shows increase in the rental pricing, which is good, which means that they're actually earning more. However, increase in all these rentals doesn't mean that it's actually a good thing as well. It's also important to take note of the tenant retention rate, which is currently at 86.2%, which is quite a very good value. So as you can see, for MIT, they are actually doing very good redevelopments by converting flatted factories into new high-tech industrial factories, which will generate more returns. Moreover, there's also pre-commitment done by tenants, which is also a very good thing, which means that the building is actually already secured by a tenant. So it's a guaranteed income that is coming as soon as it's being constructed. So with the completion at the second half of 2022 and another one in first half of 2023, it will help to boost the income for the REIT itself. So divestment of buildings can be two things. One is either the property is not good, or two, they are being forced to sell to repay debts. So the second one is definitely not a good thing, but for MIT itself, it's actually divesting all these small buildings in order to commit to better properties, which is actually a good thing. As you can see from the use of net proceeds, they are actually using it to fund for committed investments and capital requirements or reducing existing debts. Okay, so why do I say that MIT is one of the most attractive? It's because it's currently actually adopting into data centers stated by the management, and they emphasize it time and time again that data center is actually something that is going to grow exponentially in the next few years. So if you believe in data centers, MIT is one of the good REITs that you can consider. And you can see from this table that I created, based on the distribution history, MIT actually has one of the highest compounded annual growth rate, losing out to only Keppel DC and Keppel US REIT. Okay, so another well-known REIT that has nice returns, it's Keppel DC REIT. I have been looking at this company for so long, and I haven't get the chance to buy it, but with the current price and the current yield, I've been considering it. So as you can see from the name of the REIT itself, is actually a pure data center portfolio. So it has data center of different countries, and as you can see from the slides, it has a potential of acquiring potential data centers of more than 2 billion from different management of funds that is also related to Keppel itself. So that's the advantage of Keppel DC, because it can buy from the Keppel management themselves. So you can see from this overview, the distributable income is 91.2 million, and it has grown 8.2% year on year, which is a very good value. And it has a 2.5% year on year growth on the DPU growth. Moreover, it has a high occupancy rate of 98.2%, with a long-term average customer lease of 7.6 years and an aggregate leverage of only 35.3%. And if you look at the ICR, it's even better. It's 9.2%. It's much higher as compared to MIT, which is 6 times. So Keppel DC REIT has always been a very safe REIT in my opinion, and it has also has an average cost of debt of only 1.9%, which is so cheap. So in the past, whenever I read this REIT, its DPU yield is never this high before, of 5.1%, which makes it very attractive to me. So currently, for their new acquisition, they are actually acquiring China data centers of Guangdong Data Center 2 and 3 in Jiangmen. So, and you can see that it's a triple net basis lease. So it's very important for data centers to have triple net, which means that every expenses in that building is actually managed by the customer rather than by the REIT. which is a good thing because the REITs do not have to pay extra and they are only earning incomes based on the building itself. So this is the management outlook. Sometimes it's important to take all these values with a pinch of salt because they are in this industry and it's their companies. So normally management will actually state good things of what to look out for. However, for me, I feel that the cloud services will keep improving as more and more people get access to cloud. I'm sure everyone is going digitally, and example of this is how more and more people are starting to use Apple iCloud and Google Drive. So that's only two factors that is being considered. There's a lot of other things such as NVIDIA data cloud gaming, which is actually ramping up as well. So all this requires data and in clouds. So where are they being stored? They will be stored in data centers. So as you can see that they predict that the worldwide end user spending on cloud service to grow by 20.4% from 494.7 billion to 600 billion by next year. Worldwide spending on data systems to grow by 5.5% year on year to 218.6 million in 2022 and 230.4 million in 2023. European data centers revenue to increase by 57% to euros of 17.5 billion, and public cloud revenues to increase 44% to euros of 103.1 billion by 2026. So all this growth is actually very attractive, and I'm sure it will go near these values. Even if it doesn't hit the target, I'm sure it will be around that value as well. Okay, so the last dividend company that I've looked at is a bit different. It doesn't work like a REIT, but it gives dividend similar to a REIT. It's called a business trust. So this business trust is actually Keppel Infrastructure Trust. So KIT is a company that is a very solid company that helps to focus on utilities, such as you can see from this, the assets of 4.5 billion, such as the Sunoco waste plant. They also have water plants, electricity plants. Okay, so one of their biggest asset is Exxon, which is actually a very large company in Australia, which is in charge of supplying water and chemicals for agriculture, mining, life sciences, buildings and construction, and many more. So imagine which companies do not use all this, and with water and chemical being so important, it's used in everyday lives. So if you look at their distributable income comparing last year, it doesn't look as attractive as compared to the MIT and Keppel DC REIT. However, it's because there is some changes that is happening within the company itself that I'm confident that this will pull through. Moreover, they're actually making additional acquisition that is actually happening now, which will bring more income for the next few quarters. So for KIT, one of the most attractive thing about it currently is that ever since the management change, they have been making a lot of acquisition, as what they said they wanted to do. So as you can see from this article, they actually Keppel Infrastructure and Keppel Infrastructure Trust have actually purchased Keppel Marina East desalination plant. So it's like buying from their own company. So one of the good things is that they actually purchased 50% of the equity stake in the Marina East water. However, one of the highlights that you have to look at the sentence is that upon the completion of the proposed transaction of the purchase, it's expected that Keppel Infrastructure, which is the parent, and KIT, which is the current business trust, will each hold a 50 joint controlling stake in the Marina East water. However, KIT will receive 100% of the economic interest from MEW, which means that although KIT actually owns only 50% of the whole desalination plant, is getting 100% of the income that is coming from it. Where can you get this kind of agreement from? Another good acquisition on another move that they have made is that finally they have actually completed the acquisition of the 30% stake in Sing Spring desalination plant. So there's a lot of history behind it that they actually own 70% of it. 30% was actually being owned by another company, which had actually collapsed. So it took a while before they actually able to acquire this 30% stake, which is actually a good thing because this water plant is actually a profitable asset. So another purchase or investment that they have made is by jointly invest with their parent company Keppel Corp in a European onshore wind energy portfolio. As you know, that green energy has been a very popular asset nowadays, especially in Europe because of the recent war and their dependence on natural gas. So they are actually adopting quickly into renewable energy so that they can rely less on the natural gas and especially on Russia. So normally for acquisition, it's very important that companies are buying it for accretive distributable income, which means that they are guaranteed on most probably give higher yields or higher returns so that stakeholders know that their dividends will increase. As you can see from this last sentence, which is a very important sentence, this transaction is expected to support KIT's overall distributable income per unit accretion, which actually means that management are confident that it's actually will give a increase in the distribution. So if you look at KIT's debt, its gearing ratio is actually quite low of 32.6%, which gives them a lot of headroom to actually go and invest or expand their business. So for business trust, the advantage is that there's no limit cap to how much loan to asset that they can have, which can also be a risk if the management does not control the spending. For REITs, it has a gearing limit of 50%. So as you can see from these KIT loans, there's a lot of different loans from notes to different kind of debts and different debts repayment dates. However, the important thing to look at is the average interest rate of 2.1%, which is actually a very good rate. And they have 82% of their loans hedged, which means that the increase in the interest rate will not affect them as much. So as you can see from their past dividend, they have actually been giving quite a consistent rate from 2017 to 2020 before they actually converted into giving semi-annual. So previously they were actually giving quarterly or every 3 months dividends, whereas now they are actually giving every 6 months. So based on the recent dividend at 2022, they actually increased the dividend because the new management itself has a new structure where they actually would earn more as well if they actually give more dividends, which is actually a win-win situation because this new payment structure for the management would help to push to increase or improve the business to have better returns for stakeholders as well. So thank you for watching my video. Take note, this is just for financial education and it's not any financial advice as I'm not a financial expert. However, this is just my interest to share my thoughts online so that I can discuss with people. I hope that you enjoy this and leave a comment, subscribe if you like my content. Thank you.